They are accounting costs or out-of-pocket costs, actual costs. For example, if the firm purchases raw materials, let's say 100 kilograms of raw materials, and the unit price of raw materials is, let's say, 1 unit equals 10 rupees, the firm has to pay 100 into 10, 1,000 rupees out of pocket. That is accounting cost. That is accounting cost. So accounting costs, we also call them explicit costs. Explicit costs. We also call them explicit costs. Accounting costs. We also call them explicit costs. Explicit costs. And there is another version of costs which are implicit costs. Implicit costs. And implicit costs are the costs incurred for own resources. They are the costs incurred for own resources. Explicit costs are incurred for resources purchased outside the firm. Implicit costs are the costs incurred for own resources. Explicit costs are the costs incurred for resources purchased outside the firm. For example, if the firm purchases 100 kilograms of raw material from an outside supplier, at a unit cost of 10 rupees, then the explicit cost is 1,000 rupees. Explicit cost is 1,000 rupees. This is an accounting cost. This is an accounting cost. Likewise, for labor purchase from outsiders, for capital units purchased or capital units rented from outsiders, they are accounting costs. Also, we can call them explicit costs. Labor purchased from outsiders, capital units rented from outsiders, they are explicit costs. Not only resources are purchased outside the firm, not only the resources purchased outside the firm, firms can use their own resources. Their own resources. For example, sometimes the firm owns a machine. Firm owns a machine. For that, do they incur a cost at the present period of time? They might have purchased it several years ago. At the present period of time, they don't incur any monetary cost. They don't incur any cost out of their pockets. So in accounting, we don't assign any cost for them. We don't assign any monetary cost for an owned machine. Yes, of course, we assign depreciation for machine, but depreciation has its own weaknesses. Depreciation has its own weaknesses. So rather than relying on depreciation, economists suggest a meaningful way of accounting cost for own inputs, own resources. So what is the cost of own resources in economics? That is the value of the next best alternative. Value of the next best alternative. So if a firm owns a machine, they are using it in the production process. They are using it in the production process. If they are not using it in the production process, what is the next best alternative of it? If they are not using it in the production process, what is its next best alternative use? So if they are not using it in the production process, the next best alternative is to rent it out to another firm. So the firm owns a machine and the firm is using it in the production process. If they are not using it in the production process, what is the next best alternative use? What is the next best alternative use? That is to rent it out to another firm. So the cost of this own machine is the rental income that the firm can earn by renting out renting it out to another firm. So likewise, for own resources, we think about the next best alternative use and its cost. We account the value of the next best alternative use is accounted as the cost of own resources. So for own resources, the cost is the value of the next best alternative use. If it is a machine, its next best alternative use is to rent it out to another firm. So the cost of the own machine is the rental income that the firm can earn by renting it out to another firm. So that is the way of accounting costs for own resources in economics. And these are implicit costs. They are implicit costs. For explicit costs, we don't want to worry about it because they are out of pocket. They are actually made. Therefore, we don't want to worry about it. They are the costs reported in accounts. They are the costs reported in standard accounts in a firm. So they are always reported. But the thing is, for own resources, there are no any record other than depreciation. Depreciation has its own weaknesses. Therefore, economics suggests to calculate the cost of own resources by considering the value of the next best alternative use. If it is a machine, the next best alternative use is to rent it out to another firm. Then the rental income that the firm can earn by renting the machine out to another firm becomes its implicit cost. So in economics, we talk about economic costs. Economic costs is the summation of explicit costs and implicit costs. Explicit costs are also called as accounting costs. Explicit costs are also called as accounting costs. So economic cost is the summation of explicit costs and implicit costs. Explicit costs are incurred for resources purchased outside the firm. Implicit costs are incurred for owned resources. So what are the other owned resources? The firm's owner's effort. It's also kind of an own resource. The firm's owner provides its service to the firm without taking any payment from the firm. The owner provides his efforts free of charge. Monica said. Owner's effort is an own resource because the owner doesn't take any payment from the firm for his efforts. So how to account the owner's effort as an implicit cost? We have to think about the next best alternative use. What is the next best alternative use of the owner? The next best alternative use may be, rather than working for his own firm, the owner can work somewhere else. So the salary, he can work somewhere else. So the salary that the owner can earn by working for another firm is the implicit cost for the owner's efforts. So that is the way we account for the costs of owned resources. So both explicit costs and implicit costs, we consider them as opportunity costs. Both explicit costs and implicit costs are opportunity costs. How it happens? What is the opportunity cost? What does it mean by opportunity cost? Opportunity cost is the value of the next best alternative use. The next best alternative use. So in the case of owned resources, we account implicit costs for them. Implicit costs are the values of next best alternative use. They are the values of next best alternative use. So inherently, all implicit costs are opportunity costs. By definition, implicit cost is what? In the previous slide, we defined implicit costs are the value of the next best alternative use. Implicit costs are the value of the next best alternative use of own resources. So implicit costs are inherently opportunity costs, because the definition of opportunity cost and the definition of implicit costs, they are the same. The definition of opportunity cost and the definition of implicit costs, both are the same. Therefore, implicit costs are, by their nature, they are opportunity costs. By nature, implicit costs are opportunity costs. We don't want to worry about it. They are opportunity costs. Definition of opportunity cost is the value of the next best alternative use. The definition of implicit cost is implicit costs are the value of the next best alternative use. So both definitions are the same. Therefore, implicit costs, by their nature, they are opportunity costs. By nature, implicit costs are opportunity costs. We have to worry about explicit costs. Can we consider explicit costs as opportunity costs? Can we consider explicit costs as opportunity costs? To become an opportunity cost, it should be the value of the next best alternative use. Let's talk about one example for an explicit cost. as in the previous case. If we purchase 100 kilograms of raw material at a unit cost of 10 rupees, what is the explicit cost for raw materials? The explicit cost for raw materials is 1,000 rupees. 1,000 rupees. That's an explicit cost. We actually pay them out of pocket. How it becomes an opportunity cost? The definition of opportunity cost is the value of the next best alternative use. The firm has already purchased 100 kilograms of raw material at a unit cost of 10. If they don't use this stock of raw material, in the production process, what is its next best alternative use? What is the next best alternative use of this raw material stock if the firm is not going to use them in the production process? What is it? What is the next? Selling them in the market, reselling them in the market. That is it. That is the next best alternative use of the raw materials they have already purchased. By reselling them in the market, how much they can earn? They can earn the same the same value. They can earn 1,000 rupees. So explicit costs are also opportunity costs because the alternative use, the next best alternative use of purchased resources is to resell them in the market. By reselling them, they can reclaim what they have already paid. Therefore, by nature, explicit costs are also opportunity costs. Explicit costs are also opportunity costs because their next best alternative use is to resell them in the market. By reselling them, they can reclaim the same amount, the same rupee amount they have already paid for the purchased inputs. So that is how both explicit costs and implicit costs become opportunity costs for the firm. By nature, implicit costs are opportunity costs. We don't want to worry about it because the definition of opportunity cost and the definition of implicit cost are the same. But we have to be careful about explicit costs. Explicit costs, by inherently, they are not opportunity costs. If we go further by one step, we can consider them also as opportunity costs because the opportunity cost, by its definition, is the value of the next best alternative use. If we have already purchased an input, the next best alternative use of an already purchased input is to resell them in the market. By reselling them in the market, we can reclaim the same rupee amount that we have already paid. In that way, the rupee amount that we have already paid for purchase inputs, that means the explicit costs, become opportunity costs for the firm. They are opportunity costs for the firm. Clear? Any questions? So the same principle can be applied to workers purchased from outsiders, workers coming from outside workers. So if a manager is working for the firm, if a manager is working for the firm, this is an outside input. This is an outside input. The manager is an outsider. So for working in the firm pays a salary. Firm pays a salary. This salary is an explicit cost. This salary is an explicit cost. So what is the next best alternative use of the manager? Rather than hiring for this particular firm, rather than hiring this manager for this particular firm, the firm can resell the manager's efforts to an outside firm. So by hiring this manager to an outside firm, the firm can earn the same salary they have paid. So likewise, for each and every input that they have purchased from an outsider, they become opportunity costs. Okay. In the short run, we talk about several cost concepts: total cost, fixed cost, and total variable cost. As I explained before, we simplify our production model. We simplify our production model with only labor and capital. We simplify our production model with only labor and capital. Output depends on labor and capital only. As I explained before, labor is the variable input in the short run, and capital is the fixed input. In the short run. So for variable input, the firm incurs variable cost. For capital, which is the fixed input, the firm incurs fixed cost. What is the labor cost? Labor cost is unit of labor they employ multiplied by the wage rate. And as I told you earlier, the wage rate is fixed because the firm is operating in a perfectly competitive labor market. Wage rate is fixed, but labor is variable. Labor quantity depends on output level. When it comes to capital cost, capital cost is quantity of capital used in the production process multiplied by the rental rate. Here, rental rate is fixed because we assume that this firm is operating in a perfectly competitive capital market. At the same time, capital is fixed because we are in the short run. We are in the short run. In the short run, labor is the variable input, capital is the fixed input, as we assume. So capital is always fixed. So the total cost of capital is always fixed because R is fixed, capital is fixed, therefore total capital cost is always fixed. In the case of labor cost, W is fixed but not the labor. Labor is variable. Labor is variable. Variable means it varies with the quantity, with the output level. Therefore, the total labor cost is not fixed, it's variable. It's variable. So this is our simplified model for cost. We have two types of costs, variable costs and fixed costs. Fixed costs are the costs incurred for capital. Variable costs are the costs incurred for labor. So we call the variable costs total variable costs. Total variable costs. We denote them as TVC, total variable cost. For total fixed cost, we call them total fixed cost, TFC. TFC. And the total cost is TVC plus TFC. Total cost is the total variable cost plus total fixed cost. Total variable cost is the cost incurred on labor. Total fixed cost is the total cost incurred on capital. Total variable cost is the cost incurred on capital, on labor. Total fixed cost is the cost incurred on capital. Okay. Based on these basic cost concepts, these are the basic cost concepts. Based on these basic cost concepts, we derive several other cost concepts as well. They are average costs and marginal costs. Average total cost is total cost divided by output. This is simply the per unit cost. The per unit total cost. Average fixed cost is total fixed cost divided by number of units produced, number of units of output. That is the per unit total fixed cost. Per unit total fixed cost. And the average variable cost is total variable cost divided by the quantity of output. That is the per unit total variable cost. Average total cost is the summation of average fixed cost and average variable cost. Yes. Total cost is total variable cost, so total fixed cost plus total variable cost. So average total cost is average fixed cost plus average variable cost. And the marginal cost is the change in total cost when producing an extra unit of output. The change in total cost when producing an extra unit of output. That is the marginal cost. When we produce an additional output, additional unit of output, what is the extra cost that the firm has to bear? That is the meaning of marginal cost. So we calculate it by taking the difference in total cost and divide it by difference in output level. Difference in total cost or change in total cost divided by change in output level. Change in total cost divided by change in output level. Delta TC divided by delta Q. Delta TC divided by delta Q. The same thing, the same marginal cost can be calculated in another way. This is the other way of calculating marginal cost. So between total fixed cost and total variable cost, what is the only cost component that varies with the output level? Between the total fixed cost and total variable cost, what is the only cost component that varies with the output level? Only TVC. TVC is the only cost component that varies with the output level. Total fixed cost does not vary with the output level. So, what is the marginal cost? Marginal cost is the change in total cost. Change in total cost when producing an extra unit of output level. When producing an extra unit of output level, does the total fixed cost change? No, total fixed cost is always fixed. It doesn't depend on the output level. Total fixed cost does not depend on the output level. So when producing an extra unit of output, there is no change in total fixed cost. When producing an extra unit of output, there won't be any change in the total fixed cost. Therefore, this is always fixed. The only cost component that changes, when producing an extra unit of output is total variable cost. Therefore, we can calculate the marginal cost using this formula as well. Change in total variable cost divided by change in output level, because when producing an extra unit of output, only total variable cost will change. Therefore, we can calculate marginal cost either using this formula or this formula. Delta TC over delta Q or delta TBC over delta Q. Both formulas will give the same results for marginal cost, because the only cost component that varies with the output level is total variable cost. Therefore, rather than using total cost, we can use total variable cost to calculate the marginal cost. Okay. Next, we discuss about the typical behavior of cost curves. Cost curves typically behave like this. Initially, they increase at a decreasing rate. Don't you see a duster? Duster. Here we put quantity on the horizontal axis and the costs, total fixed costs, total variable costs, and total cost on the vertical axis. We have 0. Total fixed cost is a constant value. It does not depend on the output level. So whatever the output level the firm produces, total fixed cost will not vary. It's a fixed cost. It's a fixed value. It's a fixed value. So if it is 10,000, if the total fixed cost is 10,000, the value of total fixed cost will not depend on the output level. So even when producing 0 units of output, even when producing 0 quantity of output, the total fixed cost will be 10,000. When producing, let's say, 1,000 units of output, still the total fixed cost is the same. It's at 10,000 rupees. So in our simplified model, total fixed cost is for, this is for capital. Next we have the total variable cost. Total variable cost starts from 0 because when producing 0 unit of output, labor input is 0. Therefore, labor cost is also 0. So in our simplified model, total variable cost is the labor cost. Total variable cost is the labor cost. So when producing 0 unit of output, labor cost is 0. Therefore, we have to start the total variable cost curve from 0, from the origin. Total variable cost will initially increase at a decreasing rate. It will increase at a decreasing rate. You can observe its slope is decreasing. Here the slope is steeper. When we move to here, the slope is flatter. Here the slope is steeper. Here the slope is flatter. So the slope is declining. Slope of this curve is declining. That is why we say total variable cost is increasing at a decreasing rate. At a decreasing rate. Let's say up to Q1, total variable cost is increasing at a decreasing rate. Let's take a quick market. And afterward, what happens is the total variable cost starts to increase at an increasing rate. So you can observe its slope is increasing. The slope is increasing. Here the slope is flatter. When it comes to this point, the slope is very much flatter, very much steeper. Here it's flatter, here it's steeper. So the slope is increasing. That's why we say the total variable cost is increasing at an increasing rate. Increasing rate. That is the typical nature of the total variable cost curve. Total variable cost curve, initially it's increasing at a decreasing rate, and afterward it's still increasing but at an increasing rate. So the next cost concept is the total cost. Total cost is the summation of total variable cost and total fixed cost. This is the behavior of total variable cost. Total cost is fixed. So the summation of total cost is the vertical summation. The vertical summation of the two curves. Let's say at this level of output, this is the total variable cost, this is the total fixed cost, and the summation is how much? We can add this distance here. Some total cost at this much level of output is this. So similarly, if we talk about this output level, how much is the total cost? Total fixed cost is this much, total variable cost is this much. So to this we have to add the fixed cost. Somewhere here. So the total cost is the vertical summation of total cost, total variable cost and total fixed cost. So total cost is this. We have to vertically add total variable cost and total fixed cost together to find the total cost. So the shape of the total variable cost, the shape of the total cost will be almost similar to total variable cost, but it is higher. It is higher. And this vertical difference between total variable cost and total cost is what? The vertical differences, they are total fixed costs. Total fixed costs. The vertical difference between total cost and total variable cost is the total fixed cost. Total cost is total variable cost plus total fixed cost. So the difference between total cost and total variable cost is what? Total fixed cost. We can show it in the graph as well. The vertical difference between total cost and total variable cost is total fixed cost. The vertical difference between total variable cost and, the vertical difference between total cost and total variable cost is total fixed cost. And then we have these marginal cost curve and average variable cost curve and average total cost curve. They take these shapes. Marginal cost curve takes a U shape like this. Marginal cost curve takes a U shape like this. Initially, it's decreasing. Initially, it's decreasing. And it reaches the minimum point. This is the minimum point where the marginal cost is minimum. And after reaching the minimum point, it starts to increase. It starts to increase. That is the behavior of marginal cost curve. Marginal cost curve takes a U shape like this, decreasing and reaches the minimum point, and after that it increases. It takes a U shape. Then we have this average variable cost. Average variable cost is also takes a U shape. It also takes a U shape. Average variable cost takes a U shape and it behaves like this. It behaves like this. This is the minimum point of average variable cost. This is average variable cost. This is the minimum point of average variable cost. Before reaching the minimum point of average variable cost, it's decreasing and then reaches the minimum point, and afterward it starts to increase. The important feature here is the marginal cost curve goes through the minimum point of marginal cost curve goes through the minimum point of average variable cost. That is the main feature here. marginal cost curve goes through the minimum point of average variable cost. You have to be careful when drawing the marginal cost and average variable cost. Marginal cost should go through the minimum point of average variable cost. We have this marginal cost curve. This is its minimum point. And next we have the average variable cost curve. This is the minimum point of average variable cost. Marginal cost curve goes to the minimum point of average variable cost. And then we have the average total cost. Average total cost behaves like this. Average total cost, also we can simply call it average cost. It behaves like this. It also takes a U shape, and also this is the minimum point of average total cost. Marginal cost also goes to the minimum point of average total cost. Marginal cost also goes to the minimum point of average total cost. And importantly, the vertical gap between average variable cost and average total cost should be decreasing when output level is expanding. This gap is shrinking. The vertical gap between average total cost and average variable cost is shrinking. The gap is narrowing. What is the reason? What is the reason? Total cost is total variable cost plus total fixed cost. Then average cost is, average total cost is, or average cost is average variable cost plus average fixed cost. The vertical gap between average cost and average variable, that is the difference between average cost and average variable cost. What is it? Average fixed cost. The difference between average cost and average variable cost is average fixed cost. So the reason for this decreasing gap between average cost and average variable cost is average fixed cost. Average fixed cost is always decreasing. Average fixed cost is always decreasing. It is something like this. This is average fixed cost. Average fixed cost is always decreasing. Always decreasing. And also average fixed cost will never touch the quantity axis. Average fixed cost will never touch the quantity axis. Why is that? What is average fixed cost? Average fixed cost is total fixed cost divided by quantity. Can total fixed cost take negative values? No, it's always positive. Can quantity take negative values? No, it's always positive. So a positive value divided by a positive value, average fixed cost is always positive. Average fixed cost does not take zero, does not take negative values. Average fixed cost does not take zeros, and also it does not take negatives because always average fixed cost is positive and quantity is positive, so, or a positive value divided by a positive value, the result is always positive. And also average fixed cost is a fixed number. It's a fixed number. So a fixed number divided by an increasing number. Quantity is increasing. You can see along this quantity axis, it's always increasing. So a fixed number divided by an increasing value, the value should continuously decrease. The value should continuously decrease. So that is why average fixed cost is always decreasing. And this vertical difference between average cost and average variable cost is average fixed cost. The gap between average cost and average variable cost is declining. The gap between average cost and average variable cost is declining like this because of the continuously decreasing average fixed cost. This gap is narrowing because average fixed cost is continuously decreasing. So this is how marginal cost, average total cost, average variable cost, and average fixed cost behave. These are the behaviors of average cost, average variable cost, average fixed cost, and marginal costs. Always average variable cost and average cost and marginal cost, they take U shapes. But importantly, marginal cost should go through the minimum points of average variable cost and average cost. And also the gap between average variable cost and average cost should be decreasing. The reason is the average fixed cost. Okay. Okay, we have a numerical example for this. Capital is fixed, labor is variable. This is the total output. Also, we can call it Q. Total product of labor, also we can call it Q. Quantity is increasing. You have to calculate average product of labor and marginal product of labor first. Average product of labor, these are production concepts, right? These are production concepts. They are not cost concepts. So average product of labor is what? Total product of labor divided by labor. Total product of labor is Q. These are equal. And what is marginal product of labor? That is change in total product of labor divided by change in Q. Here average product of labor is 0 divided by 8. It's meaningless. 5 divided by, average product of labor. 0 divided by 0. 0 divided by 0 is not applicable. 5 divided by 1, 5. 18 divided by 2, 9. 36 divided by 3, 12. 56 divided by 4, 40. Likewise, you can calculate average product values. And what are the marginal product values? Here it's not available. Delta TPL is 5 here and delta Q is 1 here. So marginal product of labor is 5. When it comes to this point, total product increases from 5 to 18 by 13. Labor input increases from 1 to 2 by 1 unit. And marginal product of labor is 30. When moving to this point, from 18 to 36, change in total product is 18. And change in labor is 1. 18 divided by 1, the answer is 18. When moving from this point to this point, total product increases from 36 to 56 by 20. Labor input increases from 3 to 4 by 1 unit. So the marginal product of labor is 20. So likewise, you can continue your calculations. these are the answers. Actually, we have to show the marginal product values in between two levels, but for simplicity, we show them in front of the second level. The theoretically correct way of writing marginal product values is this. We have to mention the marginal product values in between two levels. In between two levels like this. That is the theoretically correct way of writing marginal product values. But for calculation, but for the convenience of calculations, we write the marginal product values in front of the second level. So if you want, you can write the marginal product values like this, but this way is also fine. This is easier to deal with, to handle with. But this is the theoretically correct way of writing marginal product values. Okay, we will take a break for 10 minutes now. Come back at 9:55.
Excuse me. So can we have the previous slide?
This one.
Next.
Alternate. This one.
Yeah.
Okay. Then here we talk about the production concepts. Average product and marginal product are production concepts. They are production concepts. And now we are going to calculate cost concepts. Cost concepts. So first we will calculate the variable cost. Variable cost is the cost for labor. Cost for labor we calculate by multiplying labor amount multiplied by the wage rate. And next we calculate the fixed cost. Fixed cost is the quantity of capital multiplied by the rental rate. And the total cost is the summation of variable cost and fixed cost. So first calculate variable cost. L into W. L is this. W is this. 0 into 10 is 0. Next we have 1 and 10. 1 into 10 is 10. Next we have 2 and 10. 2 into 10, 20. Then we can calculate the fixed cost. Fixed cost is capital amount multiplied by the rental rate. 8 into 20, 20. So as I explained before, the capital input is always fixed. Rental rate is also fixed. Therefore, sorry, this should be 160. Fixed cost is always the same. Fixed cost is always the same. When it comes to the labor cost, labor amount, it changes, but wage rate is fixed. Wage rate is fixed. And the total cost is the summation of variable cost and fixed cost. It is 160 here. It's 170, 180, 190, and 200. Likewise, you can continue the rest. Okay. If you sketch these values, you will see they will show the same shapes we discussed before. This is total fixed cost. This is total variable cost. It increases at a decreasing rate first, and afterward it increases at an increasing rate. Total cost also takes the same shape, but it lies above the total variable cost, and the gap between total variable cost and total cost is the total fixed cost. The gap between total cost and the total variable cost is the total fixed cost. Okay. Based on these values, now we are going to calculate the other cost concepts, variable cost concepts and marginal costs. So the variable cost values are the labor costs. Fixed cost values are the capital costs, and the summation of them is the total cost. So you can put the variable cost values in this column, fixed cost values in this column, and total cost values in this column, and then calculate average cost concepts, average variable cost, average fixed cost, and average total cost. These are the variable costs you have already calculated. These are the fixed costs you have already calculated. And these are the total cost, the summation of variable cost and fixed cost. Thank you. Average variable cost is total variable cost divided by Q. So for the first level of output level is 0. Total variable cost is 0. So 0 divided by 0, it's meaningless. For the second level, total variable cost is 10 and output is 5. 10 divided by 5, it's 2. For the third level, total variable cost is 20 and total output is 18. 20 divided by 18, it's 1.11. Likewise, you can continue calculating average variable cost. You simply want to divide total variable cost by output level. And then you can calculate average fixed cost. Average fixed cost is total fixed cost divided by output. For the first level of output, total fixed cost is 160. For the first level, the total fixed cost is 160 and output level is 0. 160 divided by 0, it's meaningless. And for the second level, total fixed cost is 160, output level is 5. 160 divided by 5, the answer is 32. For the third level, total fixed cost is 160, output level is 18. 160 divided by 18, the answer is 8.89. Likewise, you can continue this calculation as well. And average total cost is average variable cost plus average fixed cost. Average fixed cost plus average variable cost is the average total cost. Or else you can divide total cost by Q to calculate average total cost. So there are two ways of calculating average total cost. You can follow this formula. Total cost divided by Q. So total cost is this much divided by Q. 160 divided by Q, it's meaningless. 160 divided by Q, it's meaningless. For the second level, total cost is 170. 170 divided by 5, the answer is 34. For the third level, 180 divided by 18, the answer is 10. That is one way of calculating average total cost. The second way of calculating average total cost is you can add average variable cost and average total cost to calculate average total. So you can add average variable cost and average fixed cost to calculate average total cost. There are two ways of calculating average total cost. And next we can calculate the marginal cost. Is change in total cost divided by change in output. Or else we can calculate the same with this formula, change in total variable cost divided by change in output. Both will give the same answers. Both formulas will give the same answers for marginal cost. So when moving from the first level to second level, total cost changes by 10. Total cost changes by 10. And output changes by 5. So 10 divided by 5, the marginal cost is 2. If you want, you can write the marginal cost in front of the second level like this. But the theoretically correct way of writing marginal cost is to write marginal cost values in between two levels. That is the most correct way. If you want, you can write them in front of the second level. That is also fine. Okay, when moving from the second level to the third level, total cost increases by 10. Output increases by 13. So 10 divided by 13, the answer is 0.76. The same values you can calculate using total variable cost. If you are referring to total variable cost changes, again you will come up with the same answers. You can see here total variable cost increases by 10. Output increases by 5. 10 divided by 5, the answer is 2. When moving from the second level to the third level, total variable cost increases by 10. Total variable cost increases by 10. And total output increases by 13. 10 divided by 13, 0.96. So you can refer to either total variable cost or to total cost to calculate marginal cost. Both methods will give the same answer. Again, when moving from the third level to fourth level, total cost increases by 10, output increases by 18, 10 divided by 18, the answer is 0.55. So similar, in the same way, you can continue the calculations. And this is 0, so it's meaningless. 10 divided by 0, it should be, mathematically it should be infinity, but for this case, we can't say that marginal cost is infinity, so we consider it as meaningless. So these are the average variable cost values, average fixed cost values, average total cost values, and marginal cost values. Now we are going to see the relationships among them using numbers. We are going to observe the relationships that exist among these cost concepts with these numbers. So what do you see here? The marginal cost is minimum at this point. Marginal cost is at the minimum at this point. Initially it decreases and reaches the minimum point, and afterward it increases. It increases from 0.552 to 0.66, 0.66 to 1.25, 1.25 to 1.66. Likewise, it increases. Initially, it decreases and reaches the minimum. Afterward, it increases. So that is how the marginal cost curve behaves. It behaves like this. And then you see the average variable cost is minimum here. Average variable cost is minimum here. Before the minimum point, average variable cost is decreasing, and after the minimum point, average variable cost is increasing. And we see another relationship between average variable cost and marginal cost. You see, when average variable cost is minimum, marginal cost and average cost are equal. Marginal cost and average cost are equal. That is what we observed in our diagrams as well. You observe when average variable cost is minimum, marginal cost passes through that point. That means at this point, marginal cost is equal to average variable cost. At this point, marginal cost is equal to average variable cost. So that is what we see through these numbers. When average variable cost is minimum, average variable cost and marginal cost values are the same. That means marginal cost curve passes through the minimum point of average variable cost. Marginal cost curve is passing through the minimum point of average variable cost. Next, what we observe is average fixed cost. What do you observe? Average fixed cost is continuously decreasing. Average fixed cost is continuously decreasing. There is no any minimum or maximum point. It is continuously decreasing. It behaves like this. And it never reaches zero. It never reaches zero. It is something positive. It's always something positive. That is what we observed in this figure. Average fixed cost is continuously decreasing. And next we have the average total cost or average cost. You can see average cost or average total cost is minimum here. Average total cost is minimum here. When average total cost is minimum, it is also equal to the marginal cost. It is also equal to marginal cost. Yes, you don't see it exactly similar, but it is very much closer. If you draw the diagrams, you will see the marginal cost curve will pass through the minimum point of average total cost. So they are equal. Because marginal cost curve goes through the minimum point of average total cost. Marginal cost curve goes through the minimum point of average total cost. Marginal cost curve goes through the minimum point of average total cost. At this point, average total cost or average cost is equal to marginal cost. So in this figure, we can observe another thing that first we find the minimum point of marginal cost. Next, we find the minimum point of average variable cost. And afterward, we find the minimum point of average total cost. So this is the order in which the minimum points of each curve lies. First, we have the minimum point of marginal cost. Next, we have the minimum point of average variable cost. Next, we have the minimum point of average total cost. Here it's clear. First, we have the minimum point of marginal cost. Next, we have the minimum point of average variable cost. And afterward, we have the minimum point of average total cost. So the graphical relationships are clear with these numbers as well. With these numbers, so these numbers prove the graphical relationships we observe among these concepts. Next, we are going to see the relationship between production and cost curves. Yes, as I told you at the very beginning, cost occurs because of production. When there is no production, there is no cost. So cost has to be incurred by a firm because of production. So cost is a result of production. Because of that, cost curves and production curves also should be related. Cost curves and production curves should be related. Basically, we identify two relationships. We identify two relationships. One relationship is between average product of labor and average variable cost. And the other relationship is between marginal product of labor and marginal cost. So there are two important relationships between production curves and cost curves. This is the production curve, which is average product of labor. It is related with this cost curve, that is average variable cost. And this is the production concepts, marginal product of labor. Marginal product of labor is related with this cost curve, which is marginal cost. So these are the two relationships we observe between production curves and cost curves. These are the production curves and these are the cost curves. Don't say that the average product of labor is related to average cost. That is completely wrong. Average product of labor is related with average variable cost, not with average total cost or average cost. It's related with average variable cost. So let's see the relationships. We already have calculated the average product and marginal product values. You can see initially average product value is decreasing. Initially, average product is decreasing. Average product is decreasing and reaches the minimum. Average product is increasing initially. Initially, average product is increasing. And reaches the maximum, and afterward it declines. It declines. Marginal product is also increasing initially, and it reaches the maximum. Afterward, it declines. And the maximum point of marginal product comes first, and after we have the maximum point of average product. And when average product is maximum, average product and marginal product values are equal. When average product is maximum, average product value and marginal product values are equal. So the curves take these shapes. We have labor on the horizontal axis, average product of labor and marginal product of labor curves. Yeah. This is the marginal product of labor. This is the average product of labor. Average product of labor. We learned these relationships in the previous session. This is the maximum point of average product of labor. This is the maximum point of marginal product of labor. This is the maximum point of average product of labor. When average product of labor is maximum, average product and marginal product values are equal. That is what we observe in our calculations. So let's relate average product of labor to average variable cost. And let's relate marginal product of labor to marginal cost. Let's see how average variable cost is behaving. This is the behavior of average product of labor. The same numbers we showed previously. As we saw, average product of labor is increasing initially and reaches its maximum, and then it declines. APL rises first and reaches the maximum, and then it falls. AVC, what happens is, AVC falls initially, and AVC reaches its minimum, and then it rises. So what do you observe? There is kind of an inverse relationship between APL and AVC. When APL is increasing, AVC falls. When APL is falling, AVC is rising. When APL is maximum, AVC is minimum. So there is an inverse relationship between APL and AVC. The curves behave like this. We put labor here and APL here. APL curve looks like this. This is the maximum point of APL. And below it, I show the average variable cost. Here, the horizontal axis takes Q. Vertical axis is average variable cost. When average variable cost, when average product is maximum, average variable cost is minimum. When average product of labor is increasing, average variable cost is decreasing. When average product of labor is at its maximum, average variable cost is at its minimum. When average product of labor is declining, average variable cost is rising. So here you have to be careful. We put labor on the horizontal axis when we are drawing production curves. We put quantity on the horizontal axis when we are drawing cost curves. Right? So let's discuss the relationship between marginal product of labor and marginal cost. Marginal product of labor and marginal cost. Marginal product of labor, as we observed before, it rises initially and reaches the maximum, and afterward it declines. Correspond to that, what happens to marginal cost is, marginal cost falls initially and reaches the minimum, and then it rises. Here it's falls. Here it rises. Marginal product of labor is increasing initially and then reaches the maximum. Afterward, it declines. It falls. And correspond to that, what happens to marginal cost is, marginal cost falls initially and reaches the minimum, and afterward it rises. Again, we observe an inverse relationship between marginal product of labor and marginal cost. If we show them in a diagram, this is the maximum point of marginal product of labor. When marginal product of labor is maximum, marginal cost is minimum. Marginal cost is minimum. So when marginal product of labor is increasing, marginal cost is decreasing. When marginal product of labor is at its maximum, marginal cost is at its minimum. When marginal product of labor is declining, marginal cost is increasing. If you draw them together, one below the other, marginal product of labor, maximum here. Average variable cost for average marginal. Marginal cost is minimum. And average cost so they behave in this way. Okay, now we will focus on the long run production. We finished discussing short run production from the first session. In the first session, we finished discussing the short run production theory. And then in the second session, we finished discussing the short run cost theory. In session 1, we finished discussing short run production theory. And in session 2, we finished discussing short run cost theory. Now, this is the time to discuss long run production theory from session 1 and long run cost theory from session 2. So now I'm referring to long run production, right? In session 1, slide set 1. Did we discuss this example previously? No. We just graphically showed how the optimal use of one variable input is used in the short run. I think I explained this one. Can you remember? Short run production. So we have something left to discuss in short run production theory. In short run production theory, in the previous session, we discussed how to decide the optimum level of the variable input in the short run. For that, we use a condition, and that condition is marginal revenue product of the variable input should be equal to marginal resource cost of the variable input. Here, the variable input is labor. Variable input is labor. So the condition we can change it as marginal revenue product of labor should be equal to marginal resource cost of labor. Marginal revenue product of labor should be equal to marginal resource cost of labor. We apply this condition to find the optimum level of the variable input in the short run. The variable input we talk about is labor. So for labor, the condition is marginal revenue product of labor should be equal to marginal resource cost of labor. Marginal revenue product of labor we calculate using another formula, that is marginal product of labor multiplied by price of output. Marginal product of labor multiplied by price of output. And marginal resource cost of labor is the wage rate. So when marginal revenue product of labor is equal to marginal resource cost of labor, that is where we find the optimum level of the variable input in the short run. To find the marginal revenue product of labor, we multiply marginal product of labor by the price of output. This is the price of output. And marginal resource cost of labor is simply the wage rate. So we have this schedule. Marginal product of labor is already calculated. Marginal revenue product of labor is Ma- Marginal revenue product of labor is marginal product multiplied by the price. Price of the output is constant because this firm is operating in a perfectly competitive market. So this firm is a price taker. So whatever the output level they produce, price does not change. Price does not change. So at any level of output, the firm is ready to supply that quantity at the same unit price. So to calculate marginal revenue product of labor, we multiply marginal product values by the prices. Marginal product value multiplied by the unit price of output. That is how we calculate marginal revenue product of labor. So we have this schedule for that. We multiply marginal product of labor by the unit price of output. Unit price of output. And marginal resource cost of labor is the wage rate. Wage rate is fixed here because this particular firm is operating in a perfectly competitive labor market as well. So output market is perfectly competitive. Labor market is also perfectly competitive. Therefore, price is fixed for this firm. Wage rate is also fixed for this firm. So whatever the quantities of labor they demand, wage rate does not change. Wage rate will not change. So what is the condition to find the optimum level of the variable input? Marginal revenue product of labor should be equal to marginal resource cost of labor. So we have different marginal revenue product of labor values. These are the marginal revenue product of labor values. And these are the marginal resource cost values. Where marginal product of labor and marginal resource cost are equal. Here we have 1 point. Again, we have this point. Marginal revenue product of labor is equal to marginal resource cost of labor at this point and at this point. So what is, we have 2 options, but only one point will be the optimum level of labor in the short run. Only 1 point. What is it? What is it? If we show it graphically, it should be this. It should be this. And at this point, marginal revenue product of labor should be decreasing. Marginal revenue product of labor should be decreasing, and marginal resource cost of labor should be a constant value. Marginal revenue product of labor curve can take a shape like this as well, initially increasing and reaches its maximum, and afterward it decreasing. So at this point also, we see that marginal revenue product of labor and marginal resource cost of labor are equal. But this is not the optimum use. This is not the point where the optimum use is found. That is wrong. Only at this point, we find the optimum use of labor. Why don't we see the optimum use of labor here? Because here, at this level, it belongs to stage 1. It belongs to stage 1 of production. As we learned in the previous session, a producer will operate only in stage 2. a rational producer will not operate in stage 1 or in stage 3. A rational producer will operate only in stage 1. In stage 1, what do you observe? Marginal product of labor is decreasing. Marginal product of labor is decreasing. When marginal product of labor is increasing, it should be stage 1. Will a rational producer operate in stage 1? No. So when marginal product of labor is increasing, then a rational producer will not operate there. A rational producer will operate only when the marginal product of labor is decreasing in this stage. Therefore, in this figure also, we identify that when marginal revenue product of labor is increasing, this portion belongs to stage 1. This portion belongs to stage 1. And this portion belongs to stage 2. Therefore, the optimum use of the variable input is found only when marginal revenue product of labor is decreasing. When marginal revenue product of labor is decreasing. When marginal revenue product of labor is increasing, it belongs to stage 1. At stage 1, a rational producer will not operate. When marginal revenue product of labor is decreasing, it belongs to stage 2. In stage 2, a rational producer will operate. Therefore, we have to link this knowledge. We have to link this knowledge when deciding which is the optimum use of labor input in our calculations. Here you see marginal revenue product of labor is decreasing here. But here, marginal product of labor is increasing. So can we consider this as the optimum use of labor? No, this is not correct. Because marginal revenue product of labor is increasing over this range. It's increasing over this range. Marginal revenue product of labor is decreasing over this range. So this is okay. So the exact level of optimum level of labor, the exact optimum level of labor is at this level. At this level. And which is 8 units of labor. 8 units of labor. So the firm should use 8 units of labor at optimum level. At optimum level, the firm should use 8 units of labor . The firm should use 8 units of labor. That is where the profit is maximized. Profit is maximized. So with that, we finish discussing the short-run production theory. Short-run production theory. And we finished short-run cost theory also today. So short run is done. Any questions from short run? Next week, we will discuss the long run production period, long run cost period. So don't wait until the last moment, until you reach the final examination. Don't wait until the last minute. So you have to study from the beginning itself. So these are not rocket science. If you want to read the textbook, you are mostly welcome. It has everything explained very well. Did I show you the recommended review? The Pearl laws, microeconomics. You can read it. You don't want to read it, that is also fine. Then you can simply rely on the slides. Slide has everything to study. And I will upload some practice questions also. Similar questions will come in the final examination. So that will be from your way. Any questions from the session? Otherwise, we can finish. No questions. Yes. Now, here they were there. Do you understand what I am explaining? If there is anything that I should improve by myself, just let me know. Thank you.